you can top up your special account with cash. So think about it. Instead of buying the endowment plan, you might as well just take the money every month, put $100 into your special account, and higher than the endowment, guaranteed, and it's AAA rated. Even the insurance companies, they are not AAA rated.
Today, we want to talk about your CPF. Yes, that hard-earned money that we typically use to buy an HDB flat. It might well be your first home. But that's not all you can use it for. In case you didn't know, you could also invest your CPF monies to earn even more money, and that helps you bump up your nest egg for retirement. Welcome to CNA's Money Talks podcast. I'm Andrea Heng. Now, what do you need to know before taking the leap to invest your CPF monies? What are your options? And how do we invest our CPF monies wisely? Let's ask Christopher Tan. He is CEO of Provident. Welcome back to the Money Talks podcast.
Thank you for having me.
I want to ask you a personal question. When did you start first investing your CPF?
I've never invested my CPF.
You've never invested your CPF?
No.
Okay, why?
Except for the Singtel shares that the government gave.
Oh, right, back in the day.
But otherwise, I've never... I've always looked at sort of like my CPF as a safe money.
Okay.
And like the OA is like 2.5% floor rate, right? So I look at it like the safe bond in my portfolio.
Okay.
And my special account is 4 to 5%. Capital guaranteed, Sing dollar base. You cannot get any instruments that gives you 4 to 5% per year.
Right.
Capital guaranteed.
Okay.
So there is no reason. And I know of many investment professionals that they don't invest their CPF.
Right. So why then would be the impetus a professional like yourself would advise anyone to invest their CPF, or would you not?
We don't.
Okay.
The truth is we don't really encourage our clients to invest CPF unless they really want to, or unless they have no other sources of funds except to use CPF to invest to be able to reach their goal.
What's the proportion of clients you meet that want that say, I really have no choice, I really want to invest my CPF, I feel it's the safest thing to do?
Honestly, really, really small. Currently we manage about 1.4 billion, and out of this 1.4 billion, only about $30 million is in CPF.
Okay.
So it's really a small portion of our clients, right? Because they don't have to.
Right.
And we are not like a big fan of using CPF IS to invest. So
okay. Do you see a trend though in more younger people wanting to use their CPF to basically grow their nest egg, because some of them might not be leaving mom and dad's house yet, they're not buying their own flat yet, they're too young to buy as a single, they're not getting married yet, and they want to, apart from retail investing, they are looking at their CPF monies because they're, so to speak, chonging in their jobs, right? Do you see a trend in that direction?
I think the young people today, and not just the young people, I think a lot more people in Singapore, they're beginning to understand and appreciate the benefits of CPF. And so they are not investing it. But I know, out there are a lot of advertisements, product providers telling people to invest their CPF, because it seems like, when I invest my CPF, I don't feel so heart pain because it's not cash. I'm not touching my cash.
Exactly. Even though technically it came from your salary,
it is
right?
your money, right?
Yeah.
And of course, the younger people, they are also very well aware that they will need their money from CPF to buy their first house. Most people, when they're young, in their 20s, they will not have enough cash to put the deposit for their house. They need the CPF.
Yeah.
So I think a lot of them are guarding their CPF ordinary account monies for their house. But yes, there are still people, because of whatever advertisement they listen to and a lot of calls for them to use CPF, yes, a lot of people, they still want to use money under CPF IS to invest.
If you do come across someone like that who insists on wanting to invest their CPF monies, what's the first thing that you tell them? When's a good time to start?
If you are 18 years old, at a minimum, you are undischarged bankrupt. You have got at least 20,000 in your OA and 40,000 in your SA, because the first 20K in OA you can't invest, and the first 40K in your SA you cannot invest. Well, in a way, it's a good time.
Okay.
But if you really want to invest your CPF, I will provide a few more guidance.
Okay.
Right? The first thing I'll say is that if you have got cash and if you have got SRS money, I'll say first use your cash and SRS money to invest, not your CPF.
So you're referring to the Supplementary Retirement Scheme, right?
That's right. Why? Because you always invest from a source that gives you a lower interest, right? And cash and SRS, the interest, it really pittance, right? So you should start investing from your cash and your SRS. CPF minimum 2.5. Wait.
Okay.
If you don't have to invest your CPF, then don't invest your CPF because the interest rates are pretty high, as I mentioned. But if you want to invest your CPF, don't invest your special account. It doesn't make sense at all. 4 to 5% again. And
It's unbeatable, right?
Yeah, I'm like a spoiled recorder. I'm repeating it again. But it's really my conviction. Don't invest your special account.
Okay.
4 to 5 Sing dollar. Capital guaranteed. The interest is guaranteed. You don't experience any volatility at all. It's really not bad. There is no reason to invest your special account money. Even if someone comes and say that I can potentially give you 6-7%, the additional 2 to 3%, it doesn't justify the risk, the additional risk you have to take just to get the 2 or 3%. From the investment standpoint, the technical jargon we use is that the risk premium just isn't worth it. The additional returns you get for the risk you take is just not worth it. So if you are listening to this, my strong encouragement to you, don't touch your special account, keep it there. If you want to invest your ordinary account, I would say don't invest until you are left with $20,000.
That should be like the minimum floor.
Yeah, I mean, you can't, and then you say, okay, I'm just going to take whatever above 20. Don't do that because you really got to prepare for life uncertainties. For example, you may lose a job.
Yeah.
Right? And if you lose a job, you can't find it for the next 3 to 6 months. You need the buffer in your OA to pay for your monthly mortgage. Right? And of course, you are young and you're preparing to buy a house. You need cash in your OA. So don't invest until you're left with just $20,000. And the time comes, you got to pay the deposit for your house and you don't have.
Yeah.
So this would be some of the guidance I will provide if you really want to invest your CPF. And after considering you still want to do it, okay, go ahead and do it.
So what's a reasonable minimum amount I should wait for to see in my OA before I decide, okay, maybe I can invest that little amount?
I'll just say that, after you invest, maybe make sure that your money's in your ordinary account. You have enough for the next 12 months of mortgage, just in case you lose your job.
Okay.
Right? So it depends on your monthly mortgage, how much it is. Just make sure that after you invest, you have at least 12 months to pay for your mortgage in case you lose your job.
I'm wondering if age has anything to do also with how, I guess, in the attitude we have, in the approach for investing our CPF.
Yeah, I guess age contributes to your ability to take risks, right?
And to work, essentially. Put in work.
Yes. That's a really good point, actually, because the biggest advantage that you have when you are younger is that you will always find a job.
Exactly, yeah.
That gives you the ability to take the risk. But age, yes, because the younger you are, the more time, you can allow your investment portfolio to ride through the volatility.
Yeah.
So the younger you are, your ability to take risks is higher. You are probably more willing to take some risks. Of course, the older you are, your ability to take risks drop because you are nearer and nearer to retirement.
And it depends on your milestone as well. If you have children, for example, you might want to start scaling back on the aggressiveness of your investment habits, right?
Well, you are absolutely right because having children also affects your ability to take risks because every decision you make, you got to think twice whether you are able to take that risk. If you're single, you have got no children, your ability to take risks is very high. So yes, age does play a part in terms of influencing someone, whether he's willing to invest and what kind of instruments he used to invest.
Okay. So say we are listening to your advice here. Maybe I don't invest too much of my CPF OA funds. I just want to see what it's like, experience it, right? How much do you think is a reasonable amount to, say, play around with in terms of your... I know that you're not comfortable with that concept.
Very uncomfortable. Uncomfortable, firstly, because, well, truly there is no such thing as play money. Money is money.
And you earn all of it, right?
Yeah. So it's very difficult to say, okay, treat this as play money and then you invest and you lose it.
I'll convey that to my husband, yes.
There's really no play money. It's hard-earned money.
Exactly.
So that's the first thing. And secondly, the amount you can use depends, right? I mean, if your CPF, you have got a few 100,000, I mean, taking 10,000 is nothing. But then if you are young, you're just starting out, you have got 20, 30,000 in your CPF or say 30,000 in your CPF, even taking out 5,000 is a lot of money. So I'll say start small. Start with an amount that you truly feel comfortable. Maybe well, if you really have to force me with a number, I'll just say maybe below 5,000 just to try out.
Yeah, that's reasonable.
And if it's your first time investing, then at least you put in the money right through the volatility and see how you feel. I mean, we said to our clients as well, when they first engaged us, we always tell them, investing is for the long term.
Yes.
You don't really have to start by putting everything in.
Correct.
Yeah,
Yes.
start small, get used to it, feel comfortable. And then, you are more comfortable. Yeah, then you slowly inch in with more money.
Okay. You talked about the CPF special account as well. And obviously, it's unbeatable. 4 to 5%. I will leave it in there as well. But what can we do to enhance it, to enhance what we earn in the special account?
Well, if you can't invest it, the way to do it is to put more money into a special account. Right? So it's already very good. You are getting 4 to 5%. And so if you want to, you can top up your special account with cash. So think about it. Instead of buying the endowment plan, you might as well just take the money every month, put $100 into your special account.
I mean, you're paying for something. You might as well put it in something that has a really nice, chunky interest rate.
And higher than the endowment.
Yeah.
Guaranteed. And it's AAA rated. Even the insurance companies, they are not AAA rated. Okay, I don't know whether the industry is going to kill me after this, but it's a fact, right? Yeah, so if you got cash, every month if you put in $100, $200, that's already very good. As long as you know that it's the only time you can take out is as early as 55 years old, right?
Yeah.
So as long as you know that. And if you say that, I don't have enough cash, then if you have got sufficient OA and if you really want to use your OA to invest, you might want to consider using your OA and transfer to your special account. So that's the way to enhance, I would say, your special account by putting more money in.
Is there a cap to the SA? There is, right? Yeah.
It would be the prevailing full retirement sum.
Yes.
And today it is at 213,000.
So let's talk about some other options now. There's something called the SRS, the Supplementary Retirement Scheme, right? One of the benefits to that is the tax rebates that come with it, right? Tax relief that comes with it. How do I use that as a tool to then bump up my retirement fund later on? Because I had this confusion initially of how the SRS functioned. I thought it was part of CPF, it was within CPF, but it's actually not. It kind of works like CPF in that you put money in there, you can't take it out, but then you use it to supplement what's already been earned in your CPF. Do I have that correct?
Yeah, absolutely right. That's why it's called supplementary retirement sum. The advantage is that every year you can put up to 15,300 into your SRS account if you are Singaporean and PR. Do it before 31st of December.
Yes.
Right, and this 15,003 will not be subjected to tax in the next year.
Yes. I missed that deadline by like 3 months.
I also want to advise you, don't try and do it on the 31st December morning. Sometimes, for whatever reason, it won't work. It has happened to me before.
Oh, have you? Okay.
31st December morning, I try, and then somehow the bank wouldn't take my money.
Oh.
So do it much earlier. So the SRS is good in that regard. You get some tax relief. The downside of SRS is that it's a long wait.
Yes.
Before you are able to take it out without paying penalty. I mean, unlike the CPF, you can take it out anytime.
Right.
CPF, you can't. You can't even take it out
Correct.
until
It's locked
55.
in. Yes.
SRS, you can. You sell your investments, it goes back to your SRS account. You can take it out anytime. But if you take it out before your statutory retirement age, depending on when you first start opening your SRS account, right? If you have opened your SRS account before 1st July of 2022, your stat retirement age is 62.
Right.
If you open up your account on or after 1st
That's
July 2022, 63.
Yeah.
And if you open it up 1st July next year, then it's going to be 64.
4, that's right. Yeah.
So that's the earliest you can withdraw. And if you withdraw earlier than that, you'll be slapped with a 5% penalty on whatever you take out. And whatever you take out, it will be lumped together with your income and tax. So that's the main disadvantage.
Okay.
So if you can wait, you don't mind, quote unquote, no liquidity until then, SRS is a very good avenue because the instruments that are available is pretty broad and you save tax. I do use SRS. But that's also because I'm very near to 62.
Okay.
So I don't have to wait that long before I can
so
take
you
the
can
money out.
tahan a little bit.
I can tahan, yes.
And I believe SRS funds are also something you can use to reinvest as well. You put in the money in your SRS and then you invest it in a whole bunch of stuff
That's right.
through various platforms, right? So likewise, right, be it, no matter where the funds come from, be it OA, be it your SRS, what kind of instruments would you advise investing that money in? I'm thinking something that's a bit more secure, like bonds, investment grade bonds, stuff like that, or is that what you would recommend?
Yeah, so for your CPF, the range of products narrows. Right. So it starts from something very low risk like fixed deposits. You can use your OA to invest or buy. Right. You can buy statutory bonds like your LTA bonds, your HDB bonds. You can buy Singapore government securities. You can buy now famous treasury bills.
Yes.
Right. T-bill, 6 months T-bill, 12 months T-bill. So you can buy all that. But of course, because it's so low risk, then you've got to make sure that whatever you put your money into must at least beat your 2.5%.
Yes.
Right? T-bill is now just barely touching 2.5.
Correct.
Fixed D, you're not going to get 2.5. But yes, you can use your CPF monies to buy these kind of instruments. You can also buy, I would say, low to medium risk kind of instruments like your unit trust or your ILPs. Although I wouldn't really suggest you touch the ILPs, but you can invest in unit trust and ILPs, underlying securities, bonds and equities. I would say that's low to medium risk. Or you can buy say medium risk kind of instruments like your single premium endowments. You can buy annuities.
Right.
If the insurance
very
company...
boring, safe, slow stuff.
Yes, but there are exciting stuff coming.
Okay.
The higher risk one, you can buy ETFs that tracks even the S&P 500 index. You can buy it.
Yes.
You can buy unit trusts that invest 100% into equities. You can do it. So these are the range, but I say narrowest because there aren't many products out there. There aren't as many products as compared to SRS and cash that is CPF approved.
I see.
Right, because they all need to meet certain requirements by CPF. And CPF board has done something good for us in that they kept the investment management fees of CPF approved funds so that it doesn't they don't eat into the returns.
Right.
Cash and SRS, they are broader. So you can invest in all these things that I say, but the range will be broader. There will be more funds that you can use, more ETFs you can use. In fact, for cash, I mean, it's almost anything and everything. SRS slightly narrower, but still very broad range of these similar instruments.
They're not. It's basically because they're not subject to the same limitations that the CPF is restricted to, and rightfully so, as I said earlier. What are some common mistakes you've seen people make when it comes to investing their CPF monies?
I think not treating it like cash.
Okay.
Well, they think that this is money that I cannot touch until 55 anyway. Sometimes that may cause someone to be less careful. They don't do their due diligence. They don't know what they invest in. So I think that's the very big mistake. The second mistake I would say is that not leaving enough liquidity, which I've mentioned. Yeah, it's very, very important to do that. The third thing, I sat on the CPF advisory panel from 2014 to 2016, and we did a study on the investors investing their CPF. Most people lose money. And most people lose money not because the instruments that they invest in were bad. Of course, some were bad, very expensive.
Sure.
But one of the contributing factors that cause people to lose money is because they lack the knowledge and experience. And every time there is a crisis, they are scared, they get out.
Yeah.
Right?
And they get out. They end up getting out at the wrong time.
Yes, always, right? So, I mean, if you're an investor and listening to this and you have seen how the markets have behaved for the last 1.5 months since 2nd April when President Donald Trump announced the trade war. Liberation Day, right? And the markets went down as low as 20%. And if you have sold, when you look back at what you have invested, actually today has gone back up, right?
Correct. I was about to say,
Yeah, so the third point I was about to say is that the third mistake is not staying invested. But of course, I hesitated for a while because you really need to know that you are investing in the right things. Because if you invest in the wrong things, you can stay invested, you lose money, right? But if you know that you are investing in the correct things, meaning to say, for example, index tracking, ETFs, broadly diversified,
Yes.
you are investing in the index that tracks the all-country world index, and underlying it, you have got thousands of securities, you really don't have to worry so much. And so that the third mistake is not staying invested when you really should.
You talked about how there's this mindset, right? I think part of the problem here that we're talking about is how people feel, oh, it's my CPF money. Anything I do with it, confirm safe. That mindset, I think, is what leads people to be a bit more frivolous, I suppose, for the lack of a better term, and think that there is protection for me. So on that note, are there any risk protections?
There's no risk protection at all. If you're investing in things like unit trusts, you are investing in things like ETFs. If you lose money, you lose money.
Yeah.
The government is not going to come in and say, look, this is CPF money, guys, fund managers. Okay, you got to return the money to your clients. You cannot lose money for them.
Correct.
There is no protection, right? The only protection you get is, well, if you put it with the bank, there is the SDIC protection of up to 100,000, right? That's about all. But if you are investing in equities, bonds, I'm sorry, if you lose money, you lose money. And it's your money, even though it's CPF money.
Correct. You still have to be responsible and accountable for it, right?
That's right.
Now, we talked about Liberation Day. We talked about how things are so volatile in today's climate. What would you advise in terms of course of action, maybe relating a little bit more to CPF and what we can do with it to feel a bit more safe, a bit more secure? I mean, you have a rule, I understand, a CCC rule.
I actually believe that for the vast majority of Singaporeans, if you don't like market risk and you have no experience investing and you don't think that you have the knowledge to invest, you don't really have to.
Yeah.
It's a bit controversial, but I believe that as opposed to the 5 C's, the 3 C's is perhaps more conservative and more doable, right? The first C is cash flow management.
Okay.
Make sure that you always have surplus. Make sure that you spend below your means. Spending below your means that you earn $1. You can spend $1, but you choose to spend maybe 50 cents or 30 cents.
Yep.
You don't have to keep up with the Jonases.
Yeah.
You are not buying things that you don't need with the money that you don't want to impress the people you don't even know or care about.
Exactly.
So you always have a good surplus. And with the surplus, you know how to optimize it, put into higher yielding accounts like higher yielding interest rate accounts, T-bills, SSBs. So that's cash flow management.
Okay.
That's key. That's the first step. You have done your cash flow management well. You have achieved actually a large percentage of the success.
Okay.
Most people, they don't manage their cash flow well. Second is coverage management. Make sure that you are suitably covered. Buy all the necessary insurance. And in insurance, I have said it for a long time, buy as much as you need, but pay as little as you can.
Yeah.
Right? You don't need to spend a lot of money on insurance. You can still get yourself adequately covered.
More doesn't always mean better.
In fact, more always means bad. When it comes to insurance, especially you pay more premiums, actually usually means bad. The only way that you can achieve your goal is you die.
Yeah.
Because
exactly.
you have invested into something that you only die and you will get it. The third C is, well, we talk a lot in this episode, and that is CPF management. Yeah, take care of your CPF. It's your real money. Buy a house that you can afford. Don't overspend, because if you buy a house that you cannot afford, you zeroize your OA. Then you're not going to leave enough for your retirement. But if you take care of your CPF will take care of you. Well, I sound like CPF board officer, but it's true. If you take care of CPF, you should have a nice, tidy sum at retirement, and that will provide you for the rest of your life.
Yeah, just don't raise it to the ground. It's there for a reason. I think it's an opportunity to already have a foundation to build upon. Don't squander it, right?
Absolutely.
Chris, this was exactly the kind of episode we needed to have on Money Talks. Thank you so much for lending your thoughts.
Thank you for having me.
And I'm sure our Money Talks followers had lots to benefit, and they found this as beneficial as I did. It was great to have Chris on the podcast, and great to have you for company as well. Thanks to the team. Also, Tiffany Ang, Junaini Johari, Joanne Chan, Hanida Amin, Saye Wind. Now, if you've got any questions or comments, we would love to hear from you. You can always leave us a message or a comment. Money Talks is available on Apple Podcasts, Spotify, YouTube, and Me Listen. Ratings are more than welcome. I'm Andrea Heng, signing off for Money Talks.